Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. The 30-year fix is sitting at a 6.85, which is down from last week's 6.89. So it looks like mortgage interest rates have come a little bit down. Now, we've been talking about how they are kind of going up, going down. They're in this range right now, and we haven't really seen any big breakthroughs up towards higher interest rates, but we haven't seen anything come down lower. However, this could change with a very, very important economic event that's going on tomorrow. You will be seeing this tomorrow. So for me, that's tomorrow. But I will get into that as we get into the charts. So without further ado, let's get into those charts. The US 10-year. So like I said in the intro, really the rates have been kind of yo-yoing. They'll come up, they'll come down, but we haven't seen any really significant breakthroughs to the upside or the downside. As you can see, since really it's back in May, rates were getting a little lower towards the end of April, beginning of May. But ever since we got around, let's say like May 9th, so beginning of May, come up, come down, come up a little bit, and they have settled around here. Now, in case this is your first time, of course, the interest rate is not 4.474 for the average 30-year fixed. This is the US 10-year, which is what we use as a proxy for the mortgage rates. Now we can see that this is the case because with the bond market hasn't been doing too hot, and we see these significant declines. We will see buying pick up in the bond market. However, nothing really to get us out of this range where, like I said, the rates are just kind of yo-yoing at the moment. So when we get over to the economic data to see what's influencing some of that, like I said last week, we had solid job data, which is we had this JOLTS job openings. So it looks like 7.39 million jobs were open at that time. This is above the forecasted 7.11 million. So this was really good news. The really big, we had unemployment claims a little bit higher, 247. This was above last month's. Last week's 239. And the big event of last week was on Friday, and that was these three items. And this was the big labor data that came out last week. So we had average hourly earnings month over month, and that was increased by 0.4%. So it looks like people are earning more on average. Change in price businesses pay for labor, and this is excluding farming. All right, so this was above the consensus, and it looks like it was up from previous months, 0.2%. So wages are increasing, so that's good news. We also saw that the employment change, 139,000 jobs changed from the previous month, and this is again excluding farming industry. There's some interesting data in there too. One of the interesting little tidbits of data is that manufacturing actually was down, I want to say like 8,000. So just interesting data. Like I said, that was previously, last month's the increase in employment was 147. So this month's increase in employment was a little bit down, but it was significantly higher than the forecasted, and that's why this is good news. So it looks like wages are increasing and people are getting jobs. Unemployment rate is at this 4.2%, so that's good. And what this really just speaks to is that the labor market is not in trouble. We saw that there were a lot of layoffs in places like Washington, D.C., federal layoffs. However, that doesn't appear to have carried over to the general population. And that's something that Jerome Powell has said in any of his press conferences, where it looks like there's really not much to be concerned about with the labor market at the moment. Let's see. This week, we had... So as of recording, this is Tuesday, and not much Monday, really not much today. The big event that I was discussing, there is Wednesday and Thursday's CPI and PPI numbers. There's also the 10-year bond auction, which is definitely something that we should keep our eye on, as the mortgage interest rates are based off the 10-year yield, which of course is based off the 10-year bond. Now, CPI and PPI, these are both measures of inflation, and this is going to be month over month. We want to see what inflation has been doing. This is always a big deal every month. So the previous CPI print was 0.2%, and this is from the consumer side of things. So consumers in a basket of goods that have been determined to be representative of the overall economy. The core is just excludes food and energy as their volatile goods, but there was a 0.2% increase, which this was good. It wasn't what was expected. Now we're expected to see a 0.3%. So if this is hotter than that, if it's like a 0.5 or anything like that, this will be bad news for the stock market, potentially good news for the bond market. However, we don't want to see inflation get high, because then with the bond market, we probably would see a decline in the buying of bonds, as individuals will want a higher yield for their bonds. So really just, if this is bad, it's not good for us. Essentially is what that boils down to. We don't need to get into the nitty gritty. Just know that this CPI print, this 10-year bond auction, and this PPI print, that's going to be really important for these next couple days, looking at what is going on with the interest rates. And of course, we will be discussing that next week when we look at the rates. Like I said, the 30-year fix is sitting at a 6.85. That's down from 6.89. Like I said, just a yo-yo. I mean, rates, let's see. Yeah, so ever since around here, I'd say like May 8th, just kind of nothing crazy. Nothing really crazy with the rates. So hopefully these come down. Right now, one of the things that's going on is the stock market is doing fairly well. It looks like the stock market is heading back towards all-time highs, and as this doesn't have to be the case, but it tends to be the case that when the stock market is doing really hot, the bond market is not doing as hot, and what happens is the 10-year yield tends to increase with that. So it's kind of a trade-off with the stock market and the bond market. And, to get lower interest rates, mortgage interest rates, we probably do want to see a pullback in the stock market to see an increase in the buying of the bond market, which would lower that 30-year fixed rate. All right. Well, that's all I've got for this week. So if you guys have any questions, or if you're interested in a home loan, be sure to reach out to us at 877-TEAM-MBL, or visit us at www.mortgagesbylinda.com. All right, everyone, have a great week.